Welcome back to Tax Tuesday. In a slight variation of our regular expat tax videos, in this series of 4 episodes, we're going to be focusing on real estate tax for non-residents. If you have a property or properties where you are collecting rental income, or if you're planning to sell your home in Canada, there are specific tax requirements and obligations. Helping us navigate the murky waters are the international tax professionals at Trowbridge. It gives me great pleasure to welcome Ruby Chouhan. Ruby helps lead the Realty Tax Division at Trowbridge. She specializes in helping non-residents navigate tax issues related to ownership of Canadian property. Ruby, welcome back to another episode of Tax Tuesday.
Thank you so much for having me again, Alan.
It's good to see you here again. So we covered last week again a little bit about when you should inform CRA, and you explained that there really isn't any system in there, and whether or not you can claim management fees and how you pay taxes or withholding taxes. And what about if you're using your home as an Airbnb? So in this episode, we're going to talk a little bit about selling your home. And again, just to set it up, I'm living in Los Angeles and I'm planning on selling my home in BC. What do I need to be aware of so that I'm prepared for that sale?
I'm really glad you brought this up because there's a very different process for residents of Canada versus non-residents of Canada, where a lot of your money can be tied up with your lawyer and the CRA, and you may need access to those funds at a later time. So essentially, as a resident of Canada, you're required to report the sale on a Canadian tax return. However, as a non-resident of Canada, there's a requirement. It's called an S116 Certificate of Compliance Application Requirement.
So Ruby, can you explain a little bit about what that Certificate of Compliance is?
Yes, absolutely. And this is a really important question. So the Certificate of Compliance application, it calculates 25% of your net capital gain. And the way the process works is the Certificate of Compliance application must be submitted to the CRA within 10 days of the final completion date of the transaction. Failing to submit the Certificate of Compliance application in a timely fashion results in penalties of $100 per day up to $2,500 per non-resident taxpayer. So what happens is the Certificate of Compliance application is submitted. At the same time, your real estate lawyer is required to hold in trust 25% of the gross proceeds of sale. So for example, if you're selling your property for $1 million, 25%, $250,000 will be held in trust by your lawyer until such time the certificates are issued. In addition to that, if you have rental property, your lawyer may hold in trust up to 50% of the gross proceeds as well. I don't see that happen often, but it is something that's allowed as per the Income Tax Act. Now, the issuance of the certificates takes about 3 to 4 months. So the main concern for non-residents is that their funds are held in trust and tied up with the lawyer until the certificates are issued, in case they have a mortgage to pay off, if they're looking to use that money to buy a second property. So during the processing of the application, the CRA will request a payment of 25% of the net capital gain as calculated on the applications. That payment will be made from the money that the lawyer is holding in trust. Once the CRA receives the funds, they normally issue the certificate within about 2 to 3 weeks. And then upon receipt of the certificate, your lawyer can release the funds back to you. So that happens at the time of the sale. Then once the tax year is over, the taxpayer is required to submit a Canadian tax return to report the sale and selling related expenses. On that tax return, only 50% of your net capital gain is actually taxable. And also, because your selling related expenses are included, it lowers your capital gain even further. And usually what happens is the taxpayer is in a pretty hefty refund position because the CRA has collected too much tax at the time of processing the Certificate of Compliance application.
So one question that I have been asked before, and that is, if the property was my principal residence, am I still required to apply for that or submit that certificate of compliance?
This is a really good question because if a property is a principal residence, there may be a principal residence exemption, meaning that you may not have any capital gains tax to pay. Now, for purposes of certificate of compliance applications, the CRA still requires the taxpayer to submit the certificate of compliance application, even if there won't be a tax liability.
Okay. Ruby, thank you very much for joining me.
Thank you so much again for having me, Alan.
This is an ongoing project. For future videos, please feel free to submit your questions to us and Trowbridge by leaving a comment below. If you've submitted a question that was not answered here, there's probably a reason for that and most likely requires a full consultation. A link to Trowbridge's website is in the description, so please contact them directly. They'd love to assist. Once again, to make sure that you know when we upload a new video, hit the subscribe button and the little bell so that you get notifications. It will benefit the channel and ensure that we're able to continue doing this if you hit the like button. Thanks for watching.